But first, on the retail investor side, yeah, I think 2020 was really a sort of watershed year in terms of retail participation. If you look at a 10-year record, retail participation really hit a decade high in 2020, and a lot of it was really concentrated on the glass space. Malaysia has been fortunate, I guess, to have this unique sector, and retailers have sort of flocked to it as well because the price gains have been dramatic, and there's been quite a lot of volatility to trade as well. So now the glass story is a lot more subdued. We've seen the price action recently, and the outlook with the vaccines, etc., is much less bullish, I guess. So I think that has had a big impact on retail participation in the market, especially in the last 1 to 2 months since the vaccine booster came about. But fundamentally, if you are a retailer, and as I mentioned before, and you're looking at targets to invest in Malaysia or assets to invest in, that the sharp decline in interest rates have really been a game changer. You have a situation of oversupply in property, you have a situation of fixed income yields potentially moving up this year, i.e., no capital gains from bonds. But you have a situation where equities are now still yielding much higher than your fixed deposit rates, even on an average basis, and you can find stocks which give you 2 or 3x your fixed deposit rates. So if I was in a retailer's shoes, and I had access to liquidity, I would think the equities market will remain a very viable investment alternative. So yes, we've seen some decline in retail participation, but I don't think it's going back to the bad old days when retailers were a very small part of the market. I think they are here to stay to a certain extent, maybe not as robust as when the glass stocks were hot, but they will remain a significant participant this year. On the foreign investor side, for 10 years, we have seen foreign investment in the equity market declining in Malaysia. Yeah, it's not a pretty picture, but that is the reality of it. And this trend goes beyond cyclical issues of growth, of what's hot, what's not in the market. It's really a lot to do with Malaysia's growth position going forward. If you look at ASEAN, we are the quintessential middle-income track country. Our GDP growth has slowed. Our stock market earnings growth has slowed. It's a very old economy stock market as well. And a lot of capital flows now go to new economy stock markets or stocks, which unfortunately we don't have in any size, either in Malaysia or in ASEAN. So those are things you can't change overnight. Yeah? Those are things that are structural. So it's very difficult to go to a foreign investor. And I've been in this business for 20 years, most of it in foreign houses, and I've seen the peak, and this is really the low. It's very difficult to go to them to give them a positive picture on Malaysia in terms of bringing their money back to Malaysia, because you have so many emerging market alternatives now with higher growth, with more enticing more enticing valuations. Vietnam, Indonesia, Philippines. These are all where Malaysia was in the 90s, and they have much better growth prospects. So to be real, I don't expect foreign flows to come back in a big way. I'd be happy if they just stop selling, because that's a headwind for the market. Yeah, if they just stop selling, that's good enough for us, because we have enough domestic liquidity to take this market forward.